Tracy, and I guess the year's coming to an end. So let's talk about the outlook for neobanks in 2026. A lot has changed since I did this video last year, largely in part because of the Synapse disaster and the, I guess, the uncovering of the fact that a lot of neobanks, including some of the largest ones, just sort of like lost money. They not like they lost money like they were not profitable. A lot were and went out of business. But then you just have a lot that were like, hey, we just don't know where 20 million of our customers' money went. Whatever. So what is the outlook for 26 in less than 10 minutes, right? So if you think about it, like the model for neobanks has always been interchange fees, right, on debit credit, some lending products, embedded finance, right, where you have like integration with different merchants, and then cross selling of financial services, right, like things other than just traditional banking, whether it be securities or anything like that. And because of increased regulatory and go back, the main costs, right, when you're talking about a neobank are always going to be your sponsor bank fees, which are based on like per account, per transaction, or per API call, right? Because at the end of the day, a banking as a service provider is just literally giving a fintech APIs, right? And that's how they generate revenue. But given the increased scrutiny by regulators, primarily the OCC and then the Consumer Protection Bureau, whatever, and then state regulators, those costs have gone up, right? Not to mention the fact that there's far less banking as a service providers than there were like 5 years ago. I can remember, I went to Notre Dame and I remember looking at a list of providers like 6, 7 years ago, and the credit union that I used to like deposit the $10 check my grandma would mail me, right? It was like a banking as a service provider, which was just wild. Like they had no business doing that, like how? Anyway, they're out of business. So my point is this. So you have the cost of the sponsor bank, you have like your technology costs, and then really like the biggest cost for all these is just marketing, right? The model for like a Chime has always been like, we're going to drop every dime we have and get as many accounts as humanly possible, even if there's like $5 in each account. That's how we're going to scale this, right? And that model is becoming less palatable because really the sponsor bank fees, due to heightened like regulation, less players in the market, have gone up precipitously, right? So you're looking at it and saying, well, how am I going to make money? Okay, interchange fees. Well, too bad. In what I would kind of find to be shocking under this administration, there's been caps on interchange fees. So what used to be like a pretty solid model, not something that like was wildly but very nickel and dime, is really gone. Like it's not enough to sustain, especially when you consider that there's heightened competition within the neobank market. So then you look at lending. Well, default rates, right, especially because of the the general credit profile, right, which tend to be unbanked individuals, makes lending a very, very risky proposition. And there's also been some increased prohibitions on securitizing, like packaging these small sort of like payday advances or small like cash loans, right? And like selling them off, like like you saw in the crash of 2008 on a grand scale with mortgages. Well, that sort of died as well. So you can get into high risk lending, which you can charge whatever usury allows, but then your risk of default is really just still pretty high because the economy isn't cooking the way that it perhaps should, right? It's on behind me. The guy said it. It's not cooking. It's not cooking. So then you go to embedded finance, right? Which is like cross integration with like merchants where you get anything from like discounts, stuff like that. Sort of dying on the vine because it's just there's so many other alternatives for the merchants, right? And so it's not really that. So that leaves you with cross selling of financial services. The fintechs that get into neobanking in 2026, the ones that are going to survive and be successful, in my opinion, are the ones that are offering an array of financial services in connection with just basic banking. Because again, overwhelmingly, neobanks serve underbanked or unbanked persons or communities, whatever the case may be. So it stands to reason, right, that if you don't have the ability to get a bank account, or you've had issues, or you're banking on some kind of like, PNC and all these have these second chance where like there's very limited like functionality, or there's some, you have to keep certain money on deposit and all this kind of, and the fees are super high. You're also probably not going to have a securities brokerage account, or you're going to have issues getting like insurance or things like that. So the cross promotion and the cross selling of attendant financial services is where you've seen a lot of neobanks flourish, like over the past like 18 months. And you see a lot of fintechs that have a scalable technology. So like they're not going to get nailed on technology fees, right? They have something they can scale, and it's not sort of this package in the box like legacy system that limits them to banking, and then they have to buy a module for this or that or whatever. Something they can scale and then cross sell in addition to banking, right? All these other value add financial services. Those are the banks, the neobanks, that are thriving right now in what is really like, for all intents, a dying market to a large extent, right? And you have this Schadenfreude, like specter in the back that the OCC or a state regulator may just say, well, we've had enough, like with this banking as a service shit. We're not doing it, right? Or we're just going to impose even higher capital adequacy requirements on you, and it's not going to make any sense, right? Because again, the fees, the sponsor bank fees are so high. So to really make this work and scale this, you have to get away from that, right? Like absorb the fees, take the deposits, right? Customer deposits, opening an account as a loss leader. Then look at, what is akin to a banking as a service type partnership with a securities brokerage, insurance companies, whatever the financial service is, right? Because again, overwhelmingly, your market are the persons that don't have access to these valuable financial services, or want access, right, to services like that. And as the neobank, you have their money, right, on deposit. So the cross-selling model is really what's going to work. And if you want to scale it even further, like niche, right, the more niche you are, I think the better off you are. Like, the gig worker is sort of overdone, but if you can find like a particular niche within the economy, right, that speaks to a certain, certain profession or trade or diaspora, whatever the case may be, I think you are even more better off. But a lot of people are already rushing into those niches. So at a minimum, the cross-selling of financial projects is my outlook. 2026 neobanking, and how neobanks can survive yet another year before they inevitably get shut down. So you have any questions, adamtracy.io, and I will talk to you next time. Cheers.